Hey friends, welcome to the Singapore Market Digest for Tuesday, May 20th, 2025. I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX. Whether you're catching this on your morning commute or tuning in after work, I've got you covered with the latest updates, clear explanations, and a bit of context to help you make sense of today's market moves. Let's start with a quick look at the overall mood on the Singapore Exchange. The Straits Times Index, or STI, opened the week with some cautious optimism. Investors have been balancing global uncertainties with local corporate updates. As of midday trading today, the STI is hovering around the 3,290 mark, showing mild gains compared to last week. This follows a global trend where Asian markets are generally steady, even as investors keep an eye on U.S. inflation data and China's ongoing economic recovery. In Singapore, the focus has shifted to company-specific news, which is what we'll unpack next. First up, Singapore Post, better known as SingPost, made a big move today. If you've ever dropped off a parcel at your local post office, you might notice something new soon. SingPost has expanded its partnership with FedEx, one of the world's largest express transportation companies. Starting this week, FedEx parcel drop-off services are now available at all 43 SingPost branches island-wide, up from just 6 locations before. This means more convenience for customers and a stronger presence for both brands in Singapore's booming e-commerce scene. Why does this matter? For SingPost, this partnership is more than just adding a few counters. It signals a push to capture more of the last-mile delivery market, which is growing fast as online shopping becomes a daily habit for many Singaporeans. FedEx, for its part, gets access to SingPost's extensive network, making it easier for businesses and individuals to send parcels, both locally and overseas. This is especially timely as Singapore continues to position itself as a logistics hub in Southeast Asia. SingPost's share price has been relatively steady in recent months, trading around 55 Singapore cents as of today. Investors are watching to see if this partnership translates into higher parcel volumes and eventually stronger earnings. The company has faced challenges in the past, including rising costs and competition from new delivery startups. But with e-commerce showing no signs of slowing down, this move could give SingPost a needed boost. If you're looking at the logistics sector, keep an eye on how this partnership plays out over the next few quarters. Moving on to DFI Retail Group, which operates supermarkets, convenience stores, and hypermarkets across Asia. DFI is a familiar name for anyone who shopped at Cold Storage or Giant in Singapore. The group released its first quarter results for 2025, and there's a bit to unpack. On the surface, DFI's underlying profit for the quarter fell 18% compared to the same period last year. The main reason was the divestment of its stake in Yonghui Superstores, a major Chinese supermarket chain, which contributed a significant chunk of earnings in the previous year. But if we strip out the impact of that divestment, DFI's underlying profit actually rose 28% year on year. That's a strong performance, especially given the tough retail environment. The company is still guiding for full-year underlying profit between 230 and 270 million US dollars, supported by about 2% organic revenue growth. This suggests that, despite headwinds, DFI's core businesses are holding up well. DFI's share price closed at $2.69 US before the results were announced, down about 1.5% for the day. Investors might be reacting to the headline profit drop, but the underlying numbers tell a more positive story. The retail sector in Singapore and across Asia has been facing challenges, from rising costs to shifting consumer habits. But DFI's ability to grow its core profit, even after a major divestment, shows resilience. If you're following retail stocks, it's worth noting how DFI manages its portfolio and adapts to changing market conditions. Now let's talk about Q&M Dental Group and its subsidiary, AOX Q&M. Q&M is a leading dental services provider in Singapore with a growing presence in China through AOX Q&M. On Monday, Q&M announced that its unconditional cash offer to acquire all the shares it doesn't already own in AOX Q&M will close at 5:30 p.m. on June 16th. The offer price is set at 321 Singapore cents per share, and the company has made it clear there will be no extension or revision to this offer. This move is part of Q&M's strategy to consolidate its operations and strengthen its foothold in the dental healthcare sector. By taking full control of AOX and Q&M aims to streamline decision-making and possibly unlock more value from its China business. However, the market's reaction has been mixed. Shares of Q&M Dental Group closed 1.5% lower at 33 cents Singapore, while AOX and Q&M shares fell sharply by 18.5% to 5.3 cents Singapore before the announcement. This suggests that some investors may have been hoping for a higher offer or are uncertain about the future direction of the combined group. The dental services sector in Singapore and China is competitive, with rising demand for quality healthcare, but also increasing costs and regulatory challenges. Q&M has been expanding its clinic network and investing in new technology, which could pay off in the long run. For now, investors will be watching how the integration with AOX and Q&M unfolds and whether the group can deliver on its growth ambitions. Zooming out a bit, these three stories highlight some key trends shaping the Singapore market right now. First, we're seeing companies double down on partnerships and consolidation to stay competitive. Whether it's SingPost teaming up with FedEx or Q&M looking to fully absorb its China unit, the goal is to build scale and efficiency. Second, the retail and logistics sectors are both in the midst of transformation, driven by changes in consumer behavior, technology, and global supply chains. Companies that can adapt quickly and execute well are likely to come out ahead. It's also worth noting that Singapore's broader economy remains in a recovery phase. The latest data from the Ministry of Trade and Industry shows GDP growth for the first quarter of 2025 came in at 2.1%. Year-on-year, slightly above expectations. This was driven by resilient services and a pickup in manufacturing, even as external demand remains patchy. Inflation has moderated to around 2.8%, giving the Monetary Authority of Singapore some room to keep policy steady for now. These macro trends provide a supportive backdrop for local companies, but there are still risks on the horizon, from global interest rate moves to geopolitical tensions in the region. Looking ahead, investors will want to keep an eye on a few things. For SingPost, watch for updates on parcel volumes and any new partnerships that might emerge as e-commerce continues to grow. For DFI Retail Group, the focus will be on how the company manages costs and drives growth in its core markets, especially as competition heats up. And for Q&M Dental Group, the key question is whether the integration with AOX and Q&M leads to improved profitability and a stronger market position in both Singapore and China. Before we wrap up, let's touch on a few other market movers today. Banks like DBS, OCBC, and UOB have been trading in a narrow range, reflecting steady demand for financial stocks amid stable interest rates. Meanwhile, tech-related counters such as Venture Corporation and UMS Holdings have seen some volatility as investors react to global chip sector news and local earnings reports. Real estate investment trusts, or REITs, continue to attract attention, with CapitaLand Integrated Commercial Trust and Mapletree Logistics Trust both posting modest gains as investors look for yield in a low-interest rate environment. To sum up, today's SGX session is a reminder that staying informed about company-specific news is just as important as tracking the broader market. Partnerships, acquisitions, and earnings updates can all move stocks in the short term and shape the landscape for the months ahead. As always, make sure to do your own research, consider your investment goals, and stay tuned for more updates. That's the scoop for today. Thanks for joining me on the Singapore Market Digest. Remember, investing is a journey, not a sprint. Stay curious, stay informed, and don't forget to subscribe for more clear and concise market insights. This is Iggy from the Investing Iguana, signing off. Have a great day and happy investing.